Good evening, everyone. And this is Manish Bhandari. I run an investment firm, Vallum Capital, and today we are here along with my colleague Madhusudan Sarda to update you about the post-COVID situation in India, as well as the investment, how the landscape has changed, the investment landscape has changed in the post-COVID world. So I have a brief presentation for you, which Ankad is putting shortly, and I'll take you through the journey that what are the challenges and how the world has changed in post-COVID situation. Wonderful. Yeah, so our agenda today is the long-term trends which has emerged post the COVID situation. And is India on a strong footing? We all keep on hearing about the problems on India side. Is India is on a very strong footing on the post-COVID situation? Where do we go from the valuation side, asset price cycles, and usually different asset prices moves in a different cycle. So where do we go in the asset price cycle, and what is the framework which Vallum does? How does Vallum sees its investment various assets classes as well as on the equity side? Next. I want you to take you through the situation, what has emerged on the global side. This COVID situation is very unique, that we have an intersection of the real economic crisis, a financial economic crisis, and a health crisis. But I wanted to set the floor by looking at the situation, that what was the situation pre-COVID and why we have seen a blowouts in the financial markets and how the financial markets are behaving. So if you look at this slide, which talks about post the global financial crisis in 2008, the global GDP, the debt to the global GDP went to a stratosphere very significantly higher, $250 trillion of debt for a GDP of close to $90 trillion, significantly higher by all the standards, and which not we have seen in for more than a century, this kind of explosion in the debt. And if you look at the private sector debt, which was equally a very significantly higher in the post-COVID situation, in the last run up to the COVID, which was a last 10 years situation. Next. If you look at the situation for last 10 years, what we have very unique is there was a huge capital inflow into the US markets. And the capital inflow from the global markets to the US market happens because we saw the US yield were giving you a positive returns versus the one of the biggest economy, which is the German ECB, versus the Japanese yield. So once you have an economy which was giving you a positive return, there is a huge inflow of money which has happened to this one asset class, which is the US asset class. And you saw a bubble in most of the asset classes of US, which is a US dollar. So this is a 10-year chart of the US yield versus the German bond yield. So this shows you why there was a huge capital inflow to the US markets, to the US venture capital market, and to everything which has to related to the US dollar in the making. Next. This chart shows you that if you look at the last 10 years, the US market did very well versus any other market. The US stock market, the 35% of the US stock market was owned, is still owned by the foreigners, 35% of US Treasury, and 3% of the outstanding real estate by the US were owned by the foreigners. So that is the magnitude of the money which is flown in the US market. And I will be talking about that how this is going to change over a period of time and what are the implications for India. But these are the slides and these are the charts which are very important to set the premise that what is the world, what we have inherited pre-COVID, and how the world is changing in the post-COVID situation. Next. The post-COVID, each of the central bank has responded with unprecedented expansion in the balance sheet. This is a balance sheet of the Federal Reserve. What is important to know is that pre-global financial crisis, the central bank of the Federal Reserve balance sheet was close to $1 trillion, and it has expanded by 7 times in the last 10 years. So you can imagine that maybe the world was living on the false prosperity for a considerable period of time, And in that context, a problem like COVID came in and did puncture and it did a big reset in the global context. Next. This is the unprecedented expansion in the money supply, which has happened in response to the COVID situation. These charts are important to give you an idea that what is the amount of money which has been thrown in by the central bankers in the post-COVID situation, and how this is going to impact the various asset classes across the world. And if you look at this is the money supply from 1985 onwards, and with each of the crises, the money supply has gone to a stratosphere, and now today we are having a huge change in the money supply as relative to the GDP. And since it makes a lot of importance to from the US perspective, because US is a net provider of the liquidity to the global markets. And as you see that there hasn't been recovery in the global markets and especially in the US market. The last two slides give you an idea about the amount of money which has been thrown in the global markets to normalize the world situation in the post-COVID world. So this is giving you an idea about that how the world has responded to this real economic crisis by huge doles of money which has moved in the process. Angad, next. This is an interesting slide. And this slide talks you about that each end of the decade, you have a big regime change. And this is happening since 1980, so last 5 decades. There was a time when it was a general belief in that in 1980s that the oil will run out, and US had and the US businesses are better run. So most of the top companies, these are the slides of the top 10 companies from the market cap perspective in the global order. And in 1980s, it was a belief that the peak of the oil is there, and you will find that the oil will not be there anymore. So you have the many companies which were oil companies in peak of the 1980s. And then if you look at the contrary situation in the next decade, the situation changed so dramatically. So the same was the case in 1980s. The top 10 companies from the market cap perspective were the Japanese companies, and the situation changed. And if I flip back to 2020, the top 10 companies in the world are the technology companies. And the world believes that these technology companies are here and going to rule. Maybe a decade down, the situation will change dramatically, and we may move to the new era, which is the era of Asia. Next. Does the end of decade matter? Since we are in the start of 2020 and we are start of the new decade, does the decade matters? It is a unique coincidence that a crisis of 1929, 1969, these are the global crises, financial crises, Latin American crisis, oil crisis, or the IT crisis, or the global financial crisis in 2019 and start of 20, the COVID crisis. Most of these crises are ending with and the end of the decade, and the new start of the decade is setting up a new economic and the new monetary order. So I was just trying to figure out that is this a coincidence? Answer is yeah, this may be a coincidence, but when at the start of 2020, we are going to look at the trends which are resetting this whole global economic and the monetary order. How the situation is changing, as I said, this is an intersection of the geopolitical, financial, and the economic impact or the COVID crisis. Each one of you running a business, running an investment portfolio, ideally should look at this another decade where this big economic trends will reshape the economic, the economic situations. The last 2 decades were the decades of globalization. The post-COVID, we have heard for last 2 years about the trade war from the US, and maybe we are setting up another time for the start of the deglobalization, and it could have a long-term impacts on this. Last decade was the impact of the balance of oil supplies and the rise of oil prices for a minute time frame where we had the decline in the oil prices. Post-COVID, we have moved into an era where we are looking at abundance of the oil in the process. We have seen the last decade in the global situation where there was a budget deficits, a moderate budget deficits run by the various Western economies. We have seen the start of the decade with the huge budget deficits, and what it means is that we are going to see a low interest rate regime for considerable period of time, and it will have a huge impact on the various asset prices. We have seen the globalization has brought the government deregulations for 20 years in a row, and every time a globalization is preached, it has been preached that there should be less deregulations. Post-COVID, we are seeing as the advent of the deglobalization, the government intervention across the globe is increasing significantly. We have seen a 2 decades or 2 decades now. We will go to the last slide, Angad. We have seen the supremacy of US and the US dollar. Can this crisis and the post-COVID will shake up and will look at the rise of Asia and the rise of China? That is going to be very impactful, meaningful change. We have seen a low inflation from the geopolitical situation. We are going to see a higher inflation in the process. This is going to be one of the biggest questions in my mind, and for any of us to watch, that from a low inflation of the globalization, are we moving to a supply chain breakdown and a higher inflation in the process or not? As each crisis happens, which crisis happened in India also, and which across the world, we have seen the dollar squeeze across the world. What does a dollar squeeze mean? Suddenly a country finds its place where the export collapses, import goes down, and you see a situation where the repatriation of the financial assets happen. In FII sold 1 lakh crore of debt and equity in the process in last 1 month of the March. We are in month of May, and you see these kind of dollar squeezes happened on many occasions. So that was one of the fallout of the crisis, that we have seen suddenly rupee moving from 68, 69 levels to 75, 76 level. And that is called the dollar squeeze, and it has happened on 7 or 8 areas. And then over a period of time, the normalization also happens in the process. This is another implication, that you have seen the bond yields have gone up substantially in different directions. The spreads have widened because the crisis brings down the next level of another level of the blowouts in the yields, and these are the spreads between the AAA rated and AA rated, AAA rated and single A rated, and AAA rated and the triple B. The spreads have widened. So for some people, the interest rates have collapsed, and for some people, for some set of corporates, the interest rates have widened. So these are the ramifications of the crisis, which has really changed, and we are seeing a new normal in the process. These spreads, at least in Indian context, will go down after some period of time, but that's how the factually situation looks at this point of time in the process. So now I come to an interesting part of agenda, that I have set the premise that what was the world pre-COVID and how world has responded in the post-COVID world. And now we have an agenda that as an Indians, we look at India from what is happening around us. Let us look at India from the global context, that how the world looks at India, and is India really on the strong footing or not, or is India on a weak footing? Angad, let me take a minute to see that if I can add this presentation from my...
Sure. So should I stop my screen share?
No, not now. Let me see if I can, because it doesn't... Can you see this on my screen now?
I don't see any screen share from you.
So maybe then we need to live with your screen. You can start it, because I can't join from this side of the presentation. Okay, go ahead, Angad. Let's go ahead. So we go into the agenda, that is India on a very strong footing or not? Sure, let's go ahead. This is a slide which tells you about 2 interesting slides. When we moved into the crisis, India moved into crisis, what was the India's position versus the other emerging market countries? and the other Asian countries. Let me reiterate here that India was less vulnerable, one on the context of the forex debt maturing in the next 12 months. If you look at the other countries on your right side, there were countries which were far more vulnerable than India in the process. And if you look at the lower slide, which tells you our fiscal response by the government, which has been very muted in the process. And there is a reason why it has been, which I will take you through, that why government response has been very low in the process. But if you look at it from a response point of view, the other countries have given far higher responses to the COVID crisis versus the Indian government in the process. Next. This is another situation where if you look at the world, when the world demand destruction has happened, these are the countries which tells you about an idea about that what is their export dependence to the external world. And if you look at on the left side of your chart, India has a less export dependence in the process versus many other countries which have a huge dependence because of their manufacturing good as a percentage of their GDP, which means that the internal demand of India is significantly higher than the external demand. And in a situation when the world is going to a turmoil, you are looking at a situation where the internal demand will be a savior versus an external demand in the process. So India, if it gets act together, then it's slightly better positioned than many of the countries on the right side. And this gives you an idea about that how the world sees India, not just how India sees India. Okay. This is a slide which gives you an idea about that how India has handled this crisis. This slide is a busy slide, but let me tell you, on the left side, upper side, the intersection tells you that how much of the forex reserves has changed and how much of the yield has changed in the 10-year bond. And if you look at on the bottom side of the chart, many of these countries have seen a huge drawdown on their forex reserves and the huge change in the government yield. So the money has fled many of these countries where they found a weak fiscal situation. And the money has not fled the countries where they've not found the weak fiscal situation. If you look at India and China and many of these in the cluster, we have seen a 5% change in the forex reserves and a half a basis point or very minute changes on the government yield. So the world is looking at the fiscal situation of India in some fashion, in slightly better way versus what we are able to see from a bottom-up situation. Now we will skip this slide, Angad. We'll go to the next slide. This is a very important slide for all of us, and that's a very key message here. All of us are slightly worried, as well as we have our own views that how this crisis should have been handled. This is an interesting slide which tells you how the crisis of 2008 was handled and how the crisis of 2020 is getting handled. The normal procedure remains the same, the release of liquidity by RBI. Last time in 2008, there was close to $120 billion of liquidity which was released by RBI by way of SLR cuts, CRR cuts, which happened to the run-up to the situation, by LTROs, or what all the instruments were used in the process by the repos. And the same is a situation where close to $133 billion, roughly give and take here, of the liquidity release has happened by RBI. Last time, we enhanced the fiscal deficit by 3.5% to 7% in the 2008 crisis, when we had a different set of government and different set of mindset. In 2020 crisis, there is no major push to increase the fiscal deficit. All the fiscal deficit will increase because of the change in the denominator. What was the result of the 2008 crisis? The rupee depreciated significantly because you had an inflationary situation because of the change in the fiscal deficit as well as by the release of the liquidity. And we saw an asset inflation. What does that asset inflation led to? That asset inflation led to inflationary pressure for the next 4 years. The banking sector came out because the assets saw the inflation. So the bank was able to lend because you are seeing an inflation in the economy. And it didn't require a huge deleveraging in the process. And we have seen a deleveraging from 2016 onwards. And we saw the increase in current account deficit because rupee was depreciating. And what was the final situation? The final situation was the relative purchasing power of India goes down, and we were ready for the next crisis. The way the crisis is handled today is we are seeing a situation where there is no major push for the fiscal deficit. There is relatively less depreciation, and there is no asset inflation which is being pushed by the current set of government. What does that mean is that the inflation is contained. The banking sector slightly suffers what the banking sector didn't suffer in 2008, and the deleveraging which is already happening from the corporates in the last 4 or 5 years does accelerate. But then there is a decrease in current account deficit, and over a period of time, this crisis should lead that the India gains in the purchasing power versus the relatively other emerging markets. And the purchasing power is getting reflected, will get reflected in our currency position over a period of time. So there is a two-way and a philosophy of handling this crisis. And it is very important because this will set the premise from where India will go from here for the next decade or so. Next. This is important slide because it supplements to what I said you in the last slide. If you look at a situation where the last slide, 2008 onwards, all our measures led us to negative spiraling inflation, and we moved into an area in a regime which we saw negative real interest rate. What does a negative real interest rate means? And it is a very important term for many of the asset classes in the world, and especially for us in India also. We have a situation here where the bond yields, the inflation is running ahead of your FD or the bond yield. So you have a negative inflation. In such kind of situation, my colleague Madhu will give you an idea about what kind of asset does well or what kind of asset does badly. So if you recall from 2009 and 10 onwards till for 2014, the real estate or the hard assets did very well. For some patches, gold also did very well. So you have a situation between 2008 to 2014, a negative interest rate. If you recollect, on some occasion, the finance minister made this point that they want a positive interest. Does not want to repeat a situation of 2008 or 2014. That's the reason this time the fiscal and the monetary policy has been far more tight-fisted in the process, and that could set the long-term structural change for the Indian assets as well as for the Indian businesses in the process. So this gives you an idea about where we are from a negative inflationary regime to the real interest rate situation. And the period of 2008 to 2014 tells you one story. 2020 to 2022-23 should tell us another story in the process. Next. It has been a stated argument of government to bring down the cost of capital. And how do you bring, and where is the room to bring down the cost of capital in the process is we are looking at a situation where there is a room to bring down the cost of capital of 10-year bond yield by another 100 basis point. On an average, we were at a 4% higher. 10-year average has been close to 500 basis point more than the US Treasury. This is the chart which each country has over the US Treasury. We have another 100 basis point to go over a period of time. That's what the 10-year average chart shows. And if we have a strong monetary and a strong fiscal framework, the cost of capital will come down for all the maturities. It will start with the low risk assets, and over a period of time, it will go for the high risk assets. This chart gives you idea that what you earn over the 10-year average on the US bond in each of the country, whether it is Singapore, Thailand, Korea, or China or so. India has been significantly higher, but it has got a room to come down in the process. Next. And that's the reason I think people are taking cue from it. And if you look at it, as we have opened our debt limits, the past 5 years, the debt inflow in the Indian debt market or the government securities and other debt market has been 3 times of the foreign equities in the process. So it gives you an idea about that how the stage is getting set on the Indian fiscal side from the bringing down the cost of capital. So I gave you an idea about that how India is relatively positioned. These charts gives you idea about that how the debt flow has been in the equity in the debt market, and how do we will get positioned over a period of time as the risk premium gets down by our strong monetary and the strong fiscal framework in the process. Next. This is interesting. If you look at between 2007, a lot of time people do ask us that those were the good times between 2004 to 2008 and 9 before the global financial crisis happened, and maybe till 2013 and 14. But this slide give you some idea about that the one of the key metrics to evaluate is the changes which the government bring over a period of time. And between 2007 to 2014, the ease of doing business ranking didn't change much. Although we had a good inflationary environment and good asset prices growth, and what we have seen in last couple of years has been a very difficult deleverage cycles and a deflationary or less inflationary environment. But a lot has changed on the ground. If you look at the ranking 2014 to 2019, the ranking has changed dramatically from 140 to 63. So there is a tangible change which has happened, and which usually people do miss out these kind of tangible change because the way economy is turning topsy-turvy with the way economy is managed by the current policy maker gives you an idea about that how the it's been a painful deleveraging cycle, but this gives you an idea about that what is the restoration which is happening on the economy side in the process. So this also set up the stage for the decade of the coming decade of the India. Next, I what I conclude my section here is one, that the COVID has reset a significant change on the global world, the global monetary order, the global peaking cycle, and the decade of the last decade versus the next decade is going to be very different. India, from the monetary and the fiscal framework, is relatively far better than many of the countries. And when we look at from a top-down perspective, you get a very different picture versus what we look at from the bottom-up picture. We have two more sections to go, and I'll ask my colleague Madhu to take you through the asset classes investing style and how these top-downs does help us in the changing styles of the investments and the changing asset classes, and what are the asset classes which will do well in the what framework, and also what kind of framework does Vallum Capital employs while deploying the capital in the equity markets. Madhu, it's to you.
Thanks, Manish. So, is Angad there?
Yeah, Madhu, I'm here.
Yeah, so let's go to the slide. So, in terms of assets, as Manish showed you a chart wherein India had a significantly negative real interest rate in the period between 2008 and 2014. That was the period when, or 9 to 13 rather, wherein you can see from this chart on the upper right side, that was the period of inflationary boom. So basically, hard assets move up in those times, and those are the times when you might remember we had a real estate newsletter in 2013 when we talked about topping of the real estate cycle. So that was the end of the inflationary boom that had happened between that period, and post 2014 there was a positive real interest rate, and that has been there for last 4 years. So that is not depicted here because that typically is a disinflationary situation, and during such situation when the real interest rate is low, the normal interest rate, the bond markets tend to produce good amount of return because of the fall in the real rates. So but it also has to come with credit quality issues because deflationary situations are generally not great for credit quality. So what happened in the earlier period was that a lot of money moved to the bond markets, and you saw all these credit funds doing well between 14 and 18. Also because the real interest rate didn't move up substantially, it remained in the range between 1 to 2%. The equities did well because see, the expectation of investor is to actually make more money, and that is how when the situations of real interest rates change, they tend to change their asset classes. So Generally, investors don't do at the early end of the cycle. They generally get carried over towards the late end. But between 14 and 18, a lot of money got moved to the uh, bond or the credit markets, and also to equities given the opportunity there. So in this chart, these scenarios are being shown. So we had a positive interest rate scenario between 14 and 18, a 2% real interest rate, and a very significantly large real estate returns that the world had seen actually led them to allocate more towards equity and bonds in this period. Also in 2019, we've seen some changes in the situation. We again went back. Some inflationary crop-ups happened in the food side and the oil side. So we saw a negative situation again. But I think we will have a positive between 1 to 2% kind of positive real rate for some time to come, and that also will be there because of the global liquidity situation. So global liquidity is actually getting pushed into all the world markets because not every market is offering a positive rate. And given the macroeconomic stability, the rupee movement of last 2 3 months, I mean, this was a turmoil time. India was relatively much better than the rest of the world. So I think India will see inflows both in the debt and equity markets. Also, with respect to the business cycle that comes along with inflationary cycle, we want to give you here the framework that should be employed by any investor when they allocate to equity. And the biggest problem is people tend to look at the the 2 year, 3 year trailing returns to decide investment decisions, whereas they should be governed by this particular chart. This should be the Bible in front of every investor, and it should be pasted in front of them before they take any allocation decision. Don't look at the trailing returns, look at where you are standing in terms of the economic situation. It is always available through the GDP numbers which are being shown to you. If we are slowing down, you can see what is the right category to go overweight on. When you're contracting, which is a situation like today when our economy is contracting, there is no natural demand out there because of the lockdown, then you have a certain category of stocks doing well. Again, the recovery will happen and a certain other category of stocks will do well. And finally, the expansion, the golden period for equity. So that is the time when one has to be absolutely overweight equity. Go long, that time is going to come in a year, 1.5 years time from now when we normalize post-COVID. So yeah, there is this risk of COVID. So the contraction is going to play out for a longer period of time. Recovery will take its time, but post recovery you will have a wonderful expansion in the equity market cycle. That is the time when. So we are right now prepared to take advantage of the recovery and the expansion in the market. Through this slide, what we're trying to show is that there are years of positive and negative returns. I mean, the best name that one can think of when equity investing is done is look at the periods when Mr. Buffet has underperformed in spite of doing, a 70-year, 65-year track record of 15 to 20% plus kind of CAGR. So there will be years like these in equities, and you have to live with them because the real interest rates are hardly 2%. So if you want to beat the inflationary forces, if you want to make real addition to your wealth, then there's no choice, but you have to be equities. For Vallum, the framework that we follow, I would like to first show you how we are positioned in these current times, given the way I had shown you the allocation. So we are largely domestically focused right now, except in pharma. IT, a very small exposure. We have domestic brands, we have domestic discretionary consumption, which is 10 to 12%. We have some gold linked securities because we have a very positive view on gold prices going forward. Also, we have some domestic cyclicals where we think the cycle is going to do quite well. So overall, our portfolio is very well diversified. It's a multi-cap structure that we follow, and we tend to do much better in a good economic cycle as compared to in a deflationary cycle. So current deflationary cycle will test our patience, but and also our investors' patience. But I think the way forward is quite bright. What we look at when we decide to invest in companies, there are only 5 points which matter to us. The company that we invest in should either have a market share gain as compared to competition, or it should have a market size expansion, which means that the company will continue to grow on its potential market, addressable market size. Then we also look at companies which are upgrading their products that will lead to margin expansion. So every company keeps doing improvements in their product profile so that they can have higher contribution margins to their businesses. We always focus on those opportunities and try to position ourselves there. There are underutilized capacities and balance sheet restructuring cases which largely come in the business turnaround or the value framework that we follow. So those would be the domestic cyclicals and the cyclicals which are around 20 to 25% of our portfolio. So that is how we position as a strategy in our portfolio. When we do stock selection, we have a lot of selection and elimination processes. So we run our own screens. These screens will actually rank companies based on their performance on the financial parameters. We'll also do sector rankings, whether the sector is moving in a positive cycle or a negative cycle. This has helped us a lot in producing significant multi-baggers. We also look at the time value correction in book value, which actually means that the company is doing well, but the market is not recognizing the value of the company. We took that positioning in healthcare sector and had good exposure to healthcare for last 2 years. Also, we make sure that we do forensic checks on accounting and detailed business analysis, and also superimpose the market cap with the other peers of the business. So that's how we do the selection and the elimination of businesses. In terms of valuing or the valuation that we would like to give, we follow a very market driven process, and the market actually values a lot of businesses ultimately on the basis of the cash flows that the growth in the cash flows that the business will generate. So when we look at our portfolio, there are companies that have market cap which is actually reflecting a cash flow growth of 20%, and also a company which has fallen a lot and which is reflecting that the cash flows of the company will degrow at the rate of -28% for considerable period of time. So this is the extreme in terms of why there can be some performance related issues in a portfolio, but overall, when I look at our portfolio, it's very fairly valued and very attractively positioned for the kind of earning yields. Look at the earning yields which are being shown here, and we are at average earning yields of 8.5%, 9%. Though that is trailing 12 months, and there will be some pressure this year. But as of now, what we believe is that our companies will be able to recover earnings in the next year. So not in the FY21, but in FY22. This is, as I said, multi-cap portfolio. Our exposure to large cap is 30%, mid cap 8%, small cap 62%. And obviously, because of the performance of small caps, there are some pressures right now. So when I look at Vallum portfolio positioning post-COVID, as Manish pointed out, we have a lot of macro sightings in place, and also we have India's economic situation understood. So we were positioned to a very positive economic turnaround of India. And as you see, between 17, 18 and 19, the portfolio was positioned to actually take advantage of upcycle that might happen in India given the strong macroeconomic situation and the positive tailwinds on the consumption side. So basically we were looking at a situation where consumption led growth would actually shift to investment led growth, although it hasn't happened. But I think COVID is a blessing in disguise. It will push the government to actually pump up the investment side because consumption will take its own time to. So this is our performance, and what we think is in next 4 years or 5 years, there will be a period, short period, when the indices or the large cap or the largely large, I mean the stocks which are owned by institutions will tend to underperform, and there would be a stock pickers market. So that was typical to 2009-13 when the indices didn't produce any returns, but individual, there were a lot of individual stocks. I mean, 100 individual stocks which produced 100% kind of return, and there were more which did far better than this. So we believe this is the time when stock pickers will actually have a significant advantage as compared to the index benchmark products, which tend to be the larger mutual funds or the larger funds of that kind. What has happened in last 4 5 years is that the market has narrowed in terms of the positive value that it would have given to any business. So a lot of businesses have been losing value, not just in India. This is a global picture, and this generally happens in a deflationary situation wherein only a few set of stocks which actually have capability to grow or which are showing growth get favored. So in an inflationary situation, it's across the board reflation and all the stocks do well in terms of growth. In a deflationary situation, the growth actually boils down to very limited set of companies. And when there is low growth environment with some kind of inflation, this is the kind of market cycle that we get into. So when I showed the business cycle thing, this is what I tried to show. We are at the fag end of this cycle, and this is almost bottoming out. So with the new cycle, as Manish pointed out, the cycle of emerging markets, the cycle of dollar weakness, the cycle that will be similar to 2000 to 2008 will start. I mean, that will be the biggest catalyst for equity markets in emerging markets. Whenever that cycle starts, you'll see absolute performance across the board in equities in emerging markets, and there will be a reflation because the kind of liquidity that US has pumped, as we showed to you, the balance sheet expansions that they have done, ultimately that money cannot stay in the geographies where there are low returns. So this money will flow to the geographies which will offer positive returns, which will offer some kind of growth and some kind of reflation. So Asia is the only place in the world where demographically and for the real interest rate wise, there will be positive situation. So we see a significantly good advantage coming to India 1.5 year from now, starting 1.5 year from now. In current situation, what we believe is that given the deflationary situation, corporate bonds, very high quality, will only do well. The second best asset class that we think will do well, and that will in the short run. Second best asset class will be gold, and if you have a perspective beyond 1.5 2 years, then equity will deliver a phenomenal decadal return for you going forward. So that use this time where one has to build portfolio, add to values. This is the time to actually, a lot of questions come to us whether to add to equities at this time or not. So if you're looking at 1 to 2 year immediate performance, you can ride this corporate bond upsides and gold upside. But before it ends, you have to shift to equity, which after this underperformance will give you wonderful value situation. So I'll also show you how we are positioned with respect to valuation. So that won't be as relevant today given the COVID shock, but obviously valuation is valuation, and companies don't tend to lose value with 1 year shock kind of situation. So Ankit, we may go to the next slide. Yeah, so as Manish pointed out, this US dollar weakening is what we in Asia should wait for, because this will be the biggest trigger as and when it happens to the equity markets of Asia. To tell you a fact, US has seen investment inflows of $10 trillion, or rather the investment of foreigners in US is $10 trillion. It used to be $1 trillion in 2008-9. So it has gone 10x. Now there is a limit to what US can produce for these foreigners with that size of money. As and when dollar starts to weaken, that money will start to flow into emerging markets, and there will be, so you can say, even if 20% of that money comes in, I mean, till today, FIs have only invested 300 billion. The size of their investment in India is 3 to 400 billion dollars. And I think even if there's a 10% shift of that money from the world, India will see additional investment of size which was equal to what they've invested in the last 30 years. So that's the kind of situation that will come up. It's still not catalyzed, it's still not visible. That is why we are saying it might take 1.5 years, but use this time to build portfolios. I don't think there would be a better opportunity given this COVID related fear and the pressure on corporates to adjust to these new realities. So the valuations, there are a lot of questions about whether the market index will go to 7,500. I mean, all these questions will get answered in just one go. If you get that opportunity, just grab it. There's nothing that you need to worry about. Angad, we may go to the next slide. Yeah, so this is the situation when last time dollar did weaken. It was the period between 2000 and 2008. You see the blue rally in the emerging markets. That's the time when emerging markets really produced 4x returns on the MSCI EM basis, and that to dollar denominated. So in last 10 years, we have hardly produced any return in the dollar denominated situation. You look at the chart, the blue chart has not produced any return between 2010 and 20. Well, this is how the cycles are. If you ask me about equity market cycles, actually nothing else matters but the inflow of liquidity. And the liquidity will come when dollar starts to weaken. Angad, you may go to the other one. Yeah, so as I was saying, there is this persistent question that the market might fall to 7,500. They did fall actually, and even lower than that. So the current earning yield differential between the Nifty earnings, though they are trailing 12 months, and the bond is at a level, you see the blue line, it shows a level which was only reached in 2012-13 when our interest rates were reasonable and the Nifty valuations were far more reasonable. So we are at that point. After 2013, we produced 60% return in 12 to 14 months. I think given the COVID situation, we will have a tough 1 year. Of course, that you wouldn't get easy opportunities to actually catch the trend. So I'd be watchful of how the COVID shapes up before giving you a all long equity call. But post COVID, I'm sure valuation wise, we are very well placed. There's no reason for Indian bond yields to go up in the short run. So this kind of differential is a great opportunity. Also, we have been pointing this out for last 2 years. In the March 19 letter, Manish had very strongly propagated our view on gold, though we didn't take a straight long position on gold, but we did invest in gold linked NBFCs, and we are happy with the performance, but we continue to believe that given the way gold has delivered performance, I mean, the value in the fiat money, which is shown in the blue line in this chart against gold, is actually catalyzing a very, very big moment in gold. Well, that might happen if US starts to inflate, but until the time the COVID gets solved, there won't be bigger trigger. But gold is headed for a phenomenal dollar denominated rise, similar to the one that happened between 2000 2008. But we'll be watchful. I mean, there are uh, positive signals as of now. Well, as far as Vallum is concerned, our decisions, right and wrong, we have tried to include all of them in these slides. The ones where we took early exposures to the chemical industry, we avoided PSU banking and real estate in 13-14. We did buy quite a lot of export driven growth stories in 12-13, which did phenomenally well. So the macro calls have been great in terms of producing returns. You have times when the macro driven investing plus the domestic market situation has its own role to play. So there were challenges in 17, 18, which led to some negative performance, but our position, overweight position in pharma and holding NPFCs will tide us over, and those are set for phenomenal positive situation. And also we expect the economy to do well in a year from now, so the domestic cyclical position will also produce Angad. So if there is anything that you want to ask, we'll try to answer the questions which have been put to us.
Hi, thanks, Madhu and Manish, for that insightful chat. So we have received a few questions. If we can just address a few of them. So to start off with, I have a question that I've received from one of our senior management. So basically, they want to know that obviously you have a certain strategy and you stay true to it under most circumstances. But now you are in a very unprecedented and unforeseen situation. No one had predicted something like this a few months ago, a couple of months ago, in fact. Is there any drastic change to how you plan to relook at what you're advising in terms of holding, or are you still staying true to what it was a few months ago as well?
Madhu, I shall answer this. No, the fund management is a profession where a lot of information does hit us. A lot of data points keep on changing, and we also make tactical changes to our portfolio. Just to give you an answer, we moved into pharmaceuticals a year back, maybe not 2 years back, because we found it quite significantly undervalued relative to the markets, and close to 16 to 18% of our portfolio, more than that now, is into pharmaceuticals. So we have used those tactical opportunities at any point of time when it's given an opportunity, and we have increased slightly more in the process. But we have stayed there for 2 years in a row, and now we have started seeing the results of those changes what we did 2 years back. So post-COVID, the way I look at the situation, which is important for most of our clients and anyone who's listening to this, is uh, whenever you look at a sector or you look at the companies, you need to look at, is there a demand destruction? Is there a supply side disruption? Or is there is a demand deferment in the process? And once you put up this whole equation and jigsaw puzzle together, there are companies where one would take short-term pains, and if you believe in those companies, that those companies are survivor for a long term, and there's some kind of shaving off of the valuation has already happened in those companies. And whenever the market cycle changes, those companies will be there to rebound significantly. So market is, or the stock price or the investment is an intersection of two things. Uh, Investable idea, which is also stems from the fact that there has to be something, a valuation which has to be in your favor. And Madhu did show you a chart or a slide which gives you about the market price expectation of many of the companies which are trading today. So many of companies are middle market companies or small cap companies are expecting, the market price is expecting, the distorted market price is expecting that they will degrow for next 10 years in a row. and which is hilarious to me, very, very hilarious. These kind of situations would have occurred in many of the investment scenes across the world, and also in India many times, that a company which has grown at 14%, 15% for 10 years in a row, 5 years in a row on a cash flow basis, and that will degrow for next 10 years. These are the sentiments what market would put in front of an investment manager. And one has to look at it. In our post-COVID situation, we have evaluated our portfolio, and there is close to 8% of our, or 9% of our fund which was exposed to the discretionary consumption, which we have an auto ancillary company, and we have a retail apparel business. In hindsight, it looks like you would have not bought it, but so is the case, which any company you would say that you would have not bought it or you would have bought it. Apart from that, it doesn't change significantly and materially our, as a value investor, our thesis on any of other companies. In fact, if we get an opportunity, we will add our own stocks and we'll live through a cycle. And we are a business cycle investor who want to see the one whole business cycle. What has changed post-COVID for most of the cases, for any of the portfolio managers, including ourselves, will be the growth what one would have expected in 2021 to roll through, will roll in 2022, which Madhu was making a case that there is a change which has happened. And this is a very different era altogether. And in that context, as an equity investors, which many of you are, and anyone who is taking a levered bet on the economic cycle or so, and one has to live through it. But whenever the cycle turns, which would ideally at some point of time, definitely same kind of investments does bounces back with a lot more rigor also in the process.
Right. Thanks. So also when we talk of small and mid cap as a space, it was in a bit of strife pre-COVID, and now I think that strife has only increased for a lot of investors. So what's your general view? In fact, if I look at most of the small and mid cap funds or strategies, they are struggling to even meet benchmarks, leave aside beating them, which usually is the expectation. So what's the suggestion for an investor who's stuck in such investments, or who's invested in such strategies wherein there's gross underperformance as of now? So what should they do? Is it a good time to increase allocation, maybe average out some of their cost, hold on to their investments? So what suggestion would we have for someone who's in the small and mid cap space right now?
It's a very, again, let me reflect back. It's a very hilarious situation that there's a very famous saying by Peter Lynch, one of the best fund managers in the world for 25 years, 30 years in a row, that his fund compounded at 27 or 28% for a considerable period of time, and an average investor just made half of it. And this is quoted, well documented by him. And the reason he said that the Fidelity, where he was running a fund, he said that they did all the analysis and said that why average investor didn't make half of it, because they came in top and they went down, then went out of the investment fund in the bottom of the cycle. So investors are in a different paradise. Let me put it very straight, as if they expect a very linear equation of returns from the equity, then they have a false expectation, or they have been sold a false product in the process. They cannot have a linear expectation because equity doesn't produce a linear returns. The reason, maybe Vallum is very truthful about these facts, and the process, if you saw one chart which Madhu did showed you during the fag end, that you have a time frame where between 2009 to 2013, I remember correctly, you have a situation where BSE index never gave you any return. BSE index was down maybe 50 basis point 4 years in a row, and a mid-cap index was down 9 percentage point in a row. But there were many companies which did well in the process. So you will have a situation where a particular style, particular market caps will not do well, particular style will not do well. I don't say that I have an IPR on particular style, but those particular styles will not do well. And the investor has to identify themselves with that market cap, what he is investing into, and or the style of investing, what he is investing into, and he has to live through that the outcomes of those style in the process. if he thinks that he's stuck up in the process and that was not something he was expecting, that you can have a drawdown in any of this. But I must tell you, for it is going to be impossible for you to make a large cap because people are just holding to the safety in the process. The company is a company, whether it is a middle market or a small cap, and it is equally very interesting to say that 5,000 or 10,000 crore. So today the small cap definition of SEBI runs to a 10,000 crore market cap, 12,000 crore market cap. So a 10,000 crore company which has taken maybe 2 generations to build, and which the master trust people, and as you celebrate your 35th year, you can also identify yourself that how long it takes, can be called as a small cap. And just because the liquidity goes up and down and the price has gone up and down, can be meant that is it a good company or bad company? Answer is no. That's not the way I would look at our answer. I would look at companies carefully. There will be companies which will not make a return for 1 year. There will be companies which will not make a return. But if one has to evaluate whether there are companies which are technology decimated and they will not make returns ever in the process, then maybe you have to get out of those companies. But if you think more or less things are okay, liquidity situation has changed for a short period of time, I don't see that one has to get worried about. The bounce backs are equally very vigorous. And at some point of time, you will see that a certain set of companies which gives you a false illusion that they are just because they are large cap, so the amount of money which is chasing in is safety, then you should also brace for yourself for not making a return for a considerable period of time. And that is what has happened in many of and that's the reason you see suddenly the financial sector was significantly overweight in Nifty 40%, and 15% decline has happened on the weightage side itself. And the telecom, which was not doing well for 5 years in a row, is one of the best performing sector. So is the case in the pharmaceuticals. So these kind of wild changes will happen, and investor will have to live through this. If any investor is worried on this issue, maybe he has to use his discretion of being in ETFs and use his financial advisors to really just go through the ETFs, nothing else. That's the best advice I can tell to anyone. Otherwise, just stay with unless until, my parting note, unless until you have less than half a decade of your view on those investments as well as on the managers, I will tell you it's no point in investing in those managers if you don't believe for half a decade whether they can beat the indices or not. No manager in this world, whether it is Warren Buffett or anyone in the world, can guarantee you an absolute return in a product which is a relative return product. Yes, they have all the right to believe and say that whether the manager will be able to beat the indices or not. That's I will completely agree. And the position of the indices over a period of time ideally should get very clear, and a good manager should be able to beat the indices over a long period of time. Otherwise, I don't see how the business will be very rewarding to them.
Right. Thank you so much. And maybe one more question. So, we are already struggling on GDP forecasts and numbers, and there apparently seems to be no respite from the onslaught of COVID. In fact, I think in India is just beginning, and you might just see it multiply to very high numbers before we get control over it. So, what's your view generally on the market going forward for this year, this financial year? I mean, is it a year
I have no.
to make?
Sure, as Madhu did mention to you in his comments, it's going to be a year of survival. I would urge everyone you to look at less of the markets for this year, because it's only happened, I think, 3 times in the world when you have seen not growth, not degrowth, contraction in GDP. Leave out what happened to the index. It's a contraction in GDP. 1929, for 5 years you had a problem because of the severity of the contraction, and there were different problems because the gold was linked to the dollar was linked to the gold, and the monetary cycle itself became a self-fulfilling prophecy. So you are talking about a very unique situation in the world, and the world is trying to address it, and slugfest is through its own means and this. And one of my chart did explain you in detail that how this government is using its framework, its mindset, its framework, a very painful framework, I would say, versus the last regime. So what gives me a confidence? I have no idea what will be a GDP number. Half of the world half of the Indian believes that GDP numbers are first, and maybe all of us would also believe so. I have a very lot of faith in terms of that what the framework has been put across, and as I read and I see that the situation of 2008 versus 2020, we are in far better shape in 2020 from the framework point of view. Maybe it was an illusion in 2008 that things came up significantly well, but you saw one of the biggest, you saw the biggest inflationary environment also, and which distorted, and today that led to the deleveraging and the problems of the economy in the process. So it's going to be a year of tough time, 6 months, 7 months of consolidation, significant consolidation, and then you have some some as Madhu mentioned on the global side, where the liquidity and the other economic cycles would definitely chase various asset class in the world, and India is going to be a beneficiary, because if we are able to handle this, the monetary and the fiscal framework, that's what I can refrain myself by saying. I have no idea, because I live in Mumbai, and I equally get worried about the COVID cases. I and Madhu equally get worried about the COVID cases. So uh, uh, as long as you believe that these COVID will pass through in next 3 months, 6 months or so, through some way or other, then at least there is a gushing of liquidity which is waiting for India, and for a stable monetary regime and a stable fiscal regime, and they are looking for that. That I'm far more certain about it.
Any specific stocks and sectors that you are, bullish on, and that you expect to do far better than the average during the course of these tough times?
Yeah, we are a stock pickers as well as we look at up and down. So Madhu did mention to you, if you are a 1 year investor, then the corporate bonds are the most distorted, are giving you the most distorted pictures today. The yields what you have today on high yield bonds are simply mouth watering today. So that is one area which you can invest in. The second thing is, we did mention to you about gold, and last year also we wrote about in our annual report on the gold. This year also we made investment on, and we bought gold linked securities, which are the gold loan companies in the process, on the gold side. So gold is poised to give you a better returns in the process. Equity is there only if you are a 3 year investor, because I can't predict what is going to happen tomorrow. We try to position based on the excess of the potential return versus the attractiveness of the company. And as I mentioned to you, that pharmaceutical has a wonderful opportunity, because there's no supply side disruption, and there's no and it is coming out of a consolidation after 4 years, 4.5 years. And so if you ask me, a pharma, we own pharma in our companies, and that will do well. But there is one caveat, that going forward, I see a situation, although money will gush in, but as Madhu did showed you a chart also, you'll find a situation where a narrow band of companies will do well in the process, and this has to do with the way the architecture of economy is. And you have to find those narrow band of companies, 2 3 years, 4 years holding period. You make your money go out as the economic cycle converges with them, and it is not going to be a very generalized rally what we saw in 2003 to 2007 or so, where a complete blast of the bull run happens. That's how the nature of the market has changed. Investor also has to reconcile to this new reality. So an investor manager has to build a lot more concentration of the portfolios, and this concentration of the portfolios does well when the concentration goes in the right direction, and may not do well when the concentration doesn't go in the right direction. So that is where my answer to the investor will be, and the way they look at the market and the way they should look at the market.
Right. So we have some ardent followers of you as well on this webinar. So someone who's been following you closely on CNBC wants to know in depth what's your view on gold, and in case you have any view on real estate in India.
Uh, I don't know. I'm a prisoner of my own thoughts when it comes to real estate. I and Madhu both are very value-seeking managers, so we dig our own grave on the value when we do look at value. So I don't find a value in real estate, and I see a lot more correction in real estate. Although we were quite early in 2013, the real correction started happening in 2014, and there onwards, But let me tell you, if it's come to the residential real estate, and if I have to look at the purchasing power capacity and the purchasing power capita versus the real estate values offered here today, I still don't see a value after 7 years of the destruction, nominal destruction in the process. So I hold my view that real estate is not an investment till you can lay your hand on 6% yield or 5% minimum yield in the residential. I am not a micromanager on real estate, but if you are able to lay your hand on 5% residential yield, go and buy real estate. Otherwise, don't buy real estate. There is going to be some problem on the commercial real estate, but I think it is consolidation of office. A grade buildings will still have its value because we are into a very sweet demographics problem, sweet demographics in India. So you will still have a value for the A grade buildings, and suddenly the commercial real estate responds to the market conditions very well. So there will be the supply squeeze on the commercial real estate. So if you are a long-term holder, there should not be a great problem on the commercial, but yes, there will be consolidation in the commercial real estate on the B grade or A grade. So you have to have a triple A grade. Now you did ask me on the gold. What is interesting that I started following gold 2 years back, and what I realized is what you need to look at a gold before the big blast happens, when the real interest rate goes negative in the parts of the world, then you will see a blowout in the gold. What happens in 2008 and 9, you will be surprised that the gold also fell along with the US dollar in that process. And then 2010 onwards, so you saw a big journey of gold from 1200, 1300 to 1900. And the reason that the journey was happened because people were witnessing negative real interest rate in the gold. And thereafter, the gold fell from 1900 to 1300, and which is a mystery for many of the people of the who are following gold. Why it did fell? It fell because the world moved and the dollar was giving you a positive return. So if you saw the slide at the chart, there was a US dollar which was giving you a positive return. So gold has always acted as an alternative currency or an alternative to the US dollar. Now what you have a situation today, look at it, the way the bets are laid on today, is the dollar yield is 60 basis point. That's all. And God forbid if the inflation comes in the world because of the supply chain disruption by the deglobalization, you have a situation where dollar yield will go to negative. Who will own an asset? What gold competes with? Gold doesn't give you any interest. It doesn't get sold by the financial advisors. So what happens is gold is an asset which deserves a Nobel Prize. And why it deserves? Because once a negative real interest rate happens in the world, you will see a blowout in the gold. And the monetary base of the gold today is 9.4 trillion. That's the total gold in the world versus the total monetary base of all the central bankers put together of close to $35 trillion. And the same equation was very significantly different in 2007, before the crisis of global financial crisis. Gold was close to $5 trillion on the central bank balance sheet of not put together more than 15 trillion, 16 trillion dollars. So a lot has changed in favor of gold. There is a Warren Buffett has said that gold remains the same kilos, same in the ounces or so. But let me remind you that the gold has beaten the Berkshire Hathaway by wide margin. Gold has, if you're a 20-year holder of a gold, it has beaten the Bombay Stock Exchange also. And just because people think that it doesn't move, and people have got attuned of seeing a CNBC where the things moves up and down on the ticker side, and gold doesn't move on ticker so easily. People do forget this very noble asset classes. So I see that some allocation for the investors should be on the gold. And if you have a requirement of a real gold because of some marriage purpose in your family, then you won't get much time to buy a gold if the situation changes dramatically, because this time the move can be very violent on the gold asset prices.
Right. Thank you so much. I think that we've addressed most of the questions that we've received today. So thank you so much, Manish, and thank you so much, Madhu, for your time and for this insightful session.
Thank you, Angad. Thank you, everyone at Master Trust. And I'm so sorry I was not able to share the screen. Otherwise, I would have slightly done a better job. But no, not a problem. Adversity is also sometimes a friend. So thank you.
Problem.
Thanks a lot. Thanks everyone for listening to us.
Right.
Thank you.
Thank you. So in case for the participants, in case any of your questions remain unanswered, do reach out to us through your point of contact, or you can also visit our website, www.mastertrust.co.in. This video will also be available on our YouTube channel, so you may review it or share it with someone with whom it could be of interest. With that, we conclude this edition of our webcast. Thank you so much for tuning in, and see you soon with another hashtag Master Talk. Goodbye.